we would like to welcome our keynote speaker, finance expert and analyst, Mr. Suresh Kumar, to begin the session. Let me tell you a little bit about Mr. Suresh Kumar before we get into the session. He has 17 years of experience in stock markets in management level, has conducted more than 100 seminars, so this is nothing new to him, and has trained many successful traders. He is a BE MBA from NIT Trichy. A warm welcome to you, Mr. Suresh, and the stage is all yours. Before we get into this, ladies and gentlemen, if you have any questions, the chat box will be open. It will be directed to the co-host and the host, so you can please feel free to put your questions at the end of the session. We will get into a question and answer session. Thank you very much. Over to you, Mr. Suresh.
Okay, the agenda for the day is, at least my part of the agenda is, one, we will touch upon the basics of call and put and options. For the people, a lot of people have given a feedback saying that, no, I want to know about the option, what the option is. For them, we will briefly touch it upon. And second, we will see something about some advanced concepts like straddles, triangles, and most importantly, the other things are just theory. How are we going to make money? Do people actually make money in buying or selling options? And if at all they do, how much they do? And what are the risks involved? So I have done a lot of analysis on that. I'm going to give you the actual numbers of those analysis. So stay tuned till the end. The beginning part is mostly for the, the people who have come new to this industry, for trading. And the ending part is where you gonna learn how to make money if you already don't know that is. Okay. So normal scenario. There will be a buyer, there will be, even before going to options, suppose, let's assume there is a stock which you are buying at 1,000 rupees. What is going to happen? There are two possibilities. One, suddenly it goes to 1,500 after a period of time, let's say a month time, from 1,000 to 1,500. I need to jump in because we have only 45 minutes of time. So in between, if there is any question, Mr. Gio will read it out to us. So I will be trying to answer it. Okay. So let's go to this. Normal scenario. You are buying something, anything for that matter. Suppose you are buying for 1,000 rupees. It goes to 1,500. How much is going to profit? It's going to be the profit in it. Very simple. You bought it for 1,000. Now it's at 1,500. That is 500 rupees profit. Now, what happens in another scenario? You bought it for 1,000. There is no reason that you go to 1,500. In case it comes down to 1,500, 500. What's going to be the loss? It's going to be about 500 rupees loss, isn't it? There's nothing great about it. It's a normal transaction, normal buying and selling. This doesn't seem great, isn't it? If it goes up, you make money. If it goes down, you lose money. What's so great about it? Yeah, there's a normal transaction. That is how normal transaction works. Even in the cash market, where we call that equity, or in the futures market, where you buy, if it goes up, you make profit, goes down, if you make loss. Suppose somebody tells you, if it goes up, you take all the profit. If it comes down, you don't take any loss. Would you believe it? I would not believe it. I definitely didn't believe it till I heard of options. Options are made only for this. That is, but why should a person give you such option to you at all? If it goes up, you make profit. Okay, we'll go to this thing. This is the normal scenario. You win when you are right. You lose to the same thing when you are wrong. That's nothing great about it. But where is the advantage? We humans, and us traders mostly, I'm also a trader, we always look for some advantage over other people so that we can make money or win in life or win in whatever you want in life, that is. So what is the advantage for an option trader? Here, the thing is, heads I win, tails I don't lose much. That is, as I said, there will be some person who says that if the market goes up to 1,000 from 1,000 to 1,500, I will give you that 500 rupees profit. Suppose the market goes from 1,000 to 500, you don't have to pay the loss of 500 rupees to me. That will be too good, isn't it? But there is a catch. Why should that person give it to you? Say, that is why that person, what is his benefit? Why should he give it to you? That is the basics of options. Options is like, again, the previous slide, as it says, options is like an insurance. What happens with the insurance? I'll just briefly, I'll tell you. What happens with insurance? You buy insurance, you buy medical insurance. You pay some 20,000 rupees for your family for 10 lakh rupees insurance. I'm saying it could be any number. What happens after, say, 1 year, nothing happens. You cannot get back the 20,000. You paid something called premium, which ensures that in case you are hospitalized or somebody in the family or extended family is hospitalized, they are covered, for which you are paying something called premium. Similarly, there is an insurance for trading that is called option. You pay something called premium. It will be some amount. It could be any amount. It will be dynamically decided. I'll show it to you in a different slide. Say, suppose you are buying this 1,000. There is be a guy who will be selling this to you for this option. He says that, give me 50 rupees. Suresh, he'll come to me and say that. Suresh, or in case, Geo, he says that somebody goes to Geo and says that, I'll give you 50 rupees. Give me 50 rupees. I'll give you insurance that no matter what will be the end of the month, you can buy it from me at 1,000. Even if it goes to 1,500, you can buy it and sell it back at 1,500. You make all the profit. In case market goes down to 500, doesn't matter. Nothing, no problem at all. You don't have to give me even 1 rupee. You can just say that you take the premium, forget about the contract and move on. That is too good, isn't it? But what is his benefit? His benefit is that he will be getting the premium immediately. So if you want this kind of thing, if you want the benefits of buy, but not the side effects or the disadvantages of the buy. If the market goes down, you are at a disadvantage. You don't want that, then this is called option, a call option. Okay, what happens? Say, for example, if the 1,000 rupees, you buy it, it goes up to 1,500. You paid a premium of 50 rupees. You are at the net actual gross profit of 500 rupees that is shown in the green arrow. What is your profit here? You bought for 1,000. You paid a premium of 50 rupees. That is a cost to you. Total cost is 1,050, isn't it? And now you sold it, the market price is 1,500. You are assuming that you are selling it back at that point, 1,500 minus your cost, that will be our 450. That is the profit. Is it clear now? Because it's simple. It's the easiest of all the options. It is called the call option. If you miss it here, it's going to be a little tough over the period of time, because we're going to talk about we are not going to even talk about the put option, because it's going to take a lot of time. So this is what it is. The basic of option is call option. The call option is that it gives you a right to buy at a predetermined price, price for a premium, something called premium. You pay someone who sells you the right to it, and you don't have any disadvantage other than the premium. The maximum loss you are going to get is the premium you pay. Okay, it's simple as that. Okay, in case some people are not able to appreciate the whatever is going on here, we will conduct another session like this. We will conduct another session for this exclusively for the beginners. Since it's the mixed crowd, I need to touch upon other things also. We need to rush, because there is other eminent speaker who's going to talk a lot, much better than me. So we need to give time. So what happens here? It goes down. It goes from 1,000 to 500. If we think that 500 rupees is a loss, 500 is a loss, 1,000 to 500, and you paid a premium, you think that, okay, you paid 1,000 and 500 is the 1,050. So it goes that 550. You think that it is 550 loss? No, it is. Why? Because we actually, as we said before, premium is the only cost for you. Premium is the only cost for you. No matter what happens, even if it was to go to zero, you don't have anything to worry. The maximum cost for you is 50 rupees or the premium you have paid. So this is the, in nutshell, the basic of option. The basic of option is that there is an unlimited upside. Say, for example, you bought it for 1,000. It could go up to 10,000 too. Even then, these people has to honor the contract, and they have to honor the contract, and you will be making 9,000. How much is this? 9,000 minus 50, that would be 8,950. Even if the market goes down to zero, your entire cost is going to be maximum loss is going to be this one. Okay. So now I didn't even explain the put option. Why? Because it is going to be exactly opposite of that. Suppose you think that market is going to go down 1,000 rupees. You want to sell that contract. Okay, you expect the market to come down to 500 rupees. You want to sell the contract. So instead of that, you can buy something called put option, which will give you the right to sell it at a particular point. If something goes wrong, say, for example, you want to sell it at 1,000, but it goes up to 2,000, you don't have to worry because you paid a premium of 50. There is called a put option. You need to buy it. Okay, that's it. So in case you buy a put option, if the market goes down, you are going to make a lot of money. But, and if it goes up, again, the same thing. You don't have to worry because you paid the premium. Okay. So it seems so easy, so easy for an option buyer. Oh my God, why should I buy even a stock? Why should I buy even future? Why should I not go and buy only options? I'll be making a lot of money, isn't it? Because there is a limited downside. There's going to be unlimited upside. Oh my God, this option, this instrument is the best. I'm going to make a lot of money. If you are thinking like that, I have something to tell you. No secret because it's already there in the screen itself. 90% of the time, option buyers lose. Why? Because if you could guess, this is the thing. 90% of the thing. Why? One, earlier, only institutional investor or professional traders or HNIs, the people who actually movers and shakers of the market, they used to sell options. There would be someone who would be selling this option to you, isn't it? They are the one who sells they have the pulse of the market in their hand. They know what's happening. At least they will be able to move the market with the sheer size of the money they have in their hand and the influence they have. And that is one reason. Second, since they know a lot and they read a lot and they can influence the market, they usually don't take bets which will end up in loss. So that is why 90% of the time, people who buy options lose. Either call option or put option, any option, 90% of the time lose. Oh my God. So people should not buy options. They should sell only option. No. I'm only saying that 90% of the time they lose. But what happens in the 10% of the time? They make money. But the thing is, they make huge amount of money. The problem is, then you might question this thing. I'm not able to figure out. 90% of the time people lose, but still they make money. How is it possible? Yes, that is where we come in. I'm going to tell you and show you certain other things. This is also one of the important slides and the information also. One of the best known CEOs of a broking company in the world lately put in Twitter, they have about 30 lakh traders with them. He said that only 1% of the people actually make more money than FD. That is about 6-7% a year. Even including those people who write the options, they make only 6%. Only 1% of the people even make 1%. Then what is the difficulty? Why can't people make money? 90% of the time, writers make money. 10% of the time, they make money. Buyers make money and they make huge money sometimes. Then what is that? Is there something different, something hidden, which is not known to people? Because see, all the information, whatever you see is available uniformly for everyone these days, at least the price information. Nobody can fool around. Everybody knows what's the price is, what is the depth of the market, what is the open interest, what's happening, what is the news. Inside information you will not be getting. That's a different thing. But why is that only 1% people make money? It's because I have done a lot of seminars, and I'll tell you one little secret is that those people, this is strictly not part of option trading, it is part of any trading. Those people who want to who want to make profit or money to keep in the markets, they end up losing a lot. Those people who calculate the ads, they play for 1 year time or 2 year time to make money now, they actually end up making money. Most of the people, they come to me. See, there is one person, he's not part of this. He comes to me and says that, Suresh, I have about 2 lakh rupees with me. I want to make 50,000 rupees a month. I ask him, Do you know what percentage it is? Yeah, it is about 25%. But why do you want 50,000 from 20 to this? I have 50 lakh loan and I don't know how to pay it back. So I want to earn 50,000 rupees each month from an investment of 2 lakh rupees. I say to him, sir, people can make money in trading, particularly in options, but they cannot make it so regularly month after month without losing money. Some months you need to lose money, some months you need to make money, as I will be showing in some graphs and charts and whatnot. That is what it is. So I'll tell the people, unless and until you are clear of this, I will not be able to take your money. Why? Because first you need to know your expectations, set your expectations right. If you want to be part of that 1% who make more than FD, then you need to give up certain things. One, month-on-month profit, daily profit, or weekly profit. Surely I need to make profit. Some people come to me and say that, Suresh, one of my friends messaged me and saying, Suresh, I bought all these options. What should I do? What do I know? Did you ask me before buying it? No. Suddenly you call up and say that, okay, send a screenshot of it and say that, Suresh, what should I do? See, nobody can predict what's going to happen. Again, I'll show it in the slides, various slides. Nobody's going to know what's going to happen in the immediate future. Only thing you can do is play the odds. Okay, enough of Gyan, we'll go to this. So there are a lot of secrets, not kind of secret, it's an open secret kind of thing. The premium. See, I'm really sorry, the beginners, I have to jump so fast. We will be, definitely will be, get in touch with our team. Our team will be getting in touch with you because I need to deliver value to the people who want to make money through this. Immediately, that is where I'm going to focus. So if you want to know pure basics, get in touch with your team. We'll conduct a session specifically for this. Okay, the premium consists of 3-4 parts. One is delta, will not get there because you cannot influence delta. Other is theta. Theta is called premium, time value of this thing. What is the premium in the theta? And then vega and so many other things. The rho and all these things are there. But 2 things are very important, which you can take a decision based on that. Okay, there is something called time value of premium. That is, if you were to go see how to see this, little later I will show you an option chain, something called option chain. That will probably make it a little more clear. Okay, there is something called this thing. The premium, what happens for, this is in the case of the buyers and sellers. What will happen? If everything is same, the month beginning, so how many of you know that, I hope you know, there is a weekly expiry for Bank Nifty and Nifty and Fin Nifty, hopefully. And there is monthly. So what happens in the case, take the case of monthly expiry. What happens in the monthly expiry is that in the month beginning, the theta value, that is the time value of the money, will be very, very high. Okay, and it will not decay. It will keep on slowly decreasing the time value. If everything remains the same, if assuming the volatility doesn't move, we'll come to what volatility is. If the price even doesn't move, by the time it goes on from 1st to 24th or 22nd or whichever day it is, the premium, because of the time, will keep on reducing slowly, and after 2-3 days before the expiry, or probably 4-5 days before the expiry, suddenly it will expire. So what you can do, there's a one pro tip or semi-pro tip you can say is that if you are an option buyer, you should buy in the beginning of the month or beginning of the expiry. Why? Because that time, even after 10 days, because of the time, your premium won't have eroded. Actually, buying a premium, what happens is you are actually fighting against the time. It will keep on coming down, even if nothing happens. That is why this is called theta decay. Option sellers. So what happens is, if option seller sells in the beginning of the month, there is a risk. He will not get anything for, because of the time, there will not be any change in it. He will not be making much profit in the first 10 or 15 days. Only on the later days, he will be doing that. So in case you are a person who wants to buy, you buy it in the first beginning of the month. And before, say 1 week before, if things didn't go according to the plan, then square it off. I'll again substantiate with data. And if you are a seller, you will be able to get little premium. But the thing is, after you sold it, you will be able to get a good amount of decay. 2-3 days, you will be getting most of the money in the last 2-3 days. So if you are a seller, my suggestion to you would be sell in the fag end of the option expiry. Okay. Then why this? There is a simple explanation for it. Suppose how many of you, I don't know how many of you understand football. In case you understand football, suppose your opponent team, say, I don't know which team you like. Suppose you like Manchester United or whichever. Suppose this team is playing against some other this time. They scored 3 against your team of 0. If it is in the first half, you will be still confident because you have about 90 minutes of time. Say, let's say 10 minutes is over. Another 80 minutes is there. So many things can happen. You have a lot of heroes in your side and so many things can go right for you and it will be good. So in the first half, you'll be very, very confident. The second half beginning also, even if nobody scores a goal, you'll be still confident. But what happens in the 10th minute? I mean, if let's say 80th minute, you'll be losing all hope. At the best, one can score 1 goal. At the best, even in the miraculous situation, you'll be able to score 2 goals. Third goal in the 10 minutes, unlikely, isn't it? The same thing happens with the premium. At the beginning of the month, things can go anywhere. So that is why the premium would be high. At the end of the month or during expiry, chances of things going right or wrong becomes lesser and lesser and lesser. That is why you do that. So the time is the enemy of the option buyer. I mean, if the more time is there, it's good. The time is enemy of the option seller. If the more time is there, things can go wrong. Suppose a person sells it to you at 1,000 and if it goes to 2,000, I mean, the chances of it going to 2,000 is higher if there is 1 month. It is lesser if there is only 2 days. So that is what it is. Time is decay is one of the important things which you need to focus on. Volatility, again, I will see this. If there is a less volatile period, the ups and downs are not so great, then the premium which is shown in the pink, it is also will be little on the this thing. There will not be much high. But the volatility, if it is very, very high, the premium is going to be on the high side. This volatility is the market goes up and down, down and up, sideways, this way, that way. Nobody can predict anything. That time what happens? The premium is very, very high. So what would be an option seller do? What would be an option buyer do? When the volatility is high, you need to pay a very high premium, very, very high premium. So buyer, it is tough for him to buy it at such a high premium and actually make money. So if you are a buyer, wait for the volatility to die down a bit and then buy. If you are a seller, volatility is good for you because you will be able to command a lot of premium and chances of you making good money would be this thing. And volatility again can be measured in India VIX. There is something called, for the Nifty, there is something called VIX index. You can see that from the 28 sometime in the March, this month it has come down to 14. The VIX has come down a lot. The people who sell premium in the options and make money are getting difficult these days because the premium has come down. That the risk they are taking right now for the premium they will be charging is not proportional. So the buyers have a better chance of making money now than the sellers. I mean, it's not always the case. One more thing I need to tell you is that nothing can be predicted beyond a point. Nothing can be predicted beyond a point. No. If there is sure short way for making money in the markets, I don't know. Nobody has told me yet. And nobody knows it because I've interacted with, I have seen the trading of more than 1 lakh clients either directly under me or through my subordinates. I have seen the trading and the trading pattern. Very few actually make money and they don't make money consistently. One month they lose, the 1 month they this thing. So these are all only guidelines. So when but these guidelines are sufficient, but to help you out in this. Okay. So I told you before the call, I mean, 90%, if you can recollect, 90% of the people lose money. We have this, I mean, I told you, 90% of the buyers lose money. That means 90%, I mean, 90% of the sellers make money, isn't it? Is it really true? All the time? No. So let's see what happens. This is the 2-year data. I have a lot of data like this. In the subsequent slide, I will be showing it to you. This is an interesting thing. A person who sold a call option each month, and this is assuming that each month beginning, first day, he sells the call option and he squares off at the expiry, only at the expiry, or allowing it to expire. I mean, for the people who are new to it, I have to explain, please forgive me, because there is a lot of concept we need to tell you, which cannot be told right now, because ITM, in the money, at the money, OTM, strike price, the expiry, the further expiry, near month expiry, all these things needs to be told to you. But then there are certain advanced people, people who are traders are also there. For them also I need to do justice. So just need to tell you that. So what happens here? 2 years data. If a person just sells a call option at the beginning of a month, and then allow it to go to the expiry. I mean, only ATM option. The people who knows about the ATM, yes, they will appreciate it. Only the ATM option, if he's selling and allowing it to expire, what happens? Couple of months, they make good money. But then suddenly, one fine day, they lost 1,60,000 rupees, 1 month. 1 month, they lost 1,60,000. And how much is the margin that is required for taking a call, writing a put right now? It is about 1,50,000 rupees. About, let's say, 1,50,000 to 2,00,000 rupees. It's here and there. Okay. So entire capital is gone in 1 month. So what did I say? 90% of the time, the people who write make money, but the 10%, sometimes something big can go wrong and they end up losing almost all the money. So what happens is they end up losing. In that particular year, they lost. Here, if you can see in the red in the down, you'll see the 2,06,000 rupees was the loss in that particular year. That is the last year, because of the violent movements. Does it happen all the time? No. But can it happen? Yes, it can happen. So this is one of the cases. That is why I taken 2 years data. So these kind of things can happen. So this is the risk the call writer or a put writer or the option writer for the premium. The premium he would have got, how much he would have got? He would have got about 15,000 rupees. I don't know. I will check it up what it is. So this is the case for call writer. So things can go wrong for the premium listing. So what happens to the people who bought it? Exactly opposite of that. Yeah, they would have made exactly the similar amount of money. And the good thing about that is they would have paid about 15,000 only as the premium. The investment for buying a call option is only 15,000 or something like that, or even lesser. I will show you little later how much is the money that actually taken. For selling a premium, this thing option, you need 1,50,000 and odd, somewhere close to 1,50,000 to 2,00,000. For buying a option, it takes less, probably 10,000, 15,000 rupees here and there. It depends on the volatility, as I said, the beginning of the month and the time value and the moneyness of the option, all these things are there. But we will get to that. So the person who did exactly opposite of that, he would have made 1,45,000 rupees with the investment of, let's say, 15,000. Some months he will be losing. So let's say with the investment of 50, 60,000 rupees. So in 2 years, you could have theoretically doubled this money. But the problem is, you have to appreciate this. First month, he lost 15,000. Come down, in the lower part of it, you will be able to see. Lower part, first month, July. I mean, we started taking from July 2019. He lost 15,000. Then he made 4,000. And then again 15,000. Then he made some money. Then some, I mean, it will be reverse of that. It will be reverse of that. I mean, whatever is red for the seller will be this thing. So what happens is this person will be losing some money every now and then, but one particular time he will be making it big. We don't know when it is. That is the beauty of trading. We don't know when. But the thing is, we can plan, and that is the edge. You don't know when. That is one of the beauty and the edge you have. Because the people who come new to this, they want certainty. They want to know how much they can make a month. But nobody can say for sure, and that is your advantage. If you play your cards right, and if you think that you can wait up to 2 years and keep on investing on 15,000 rupees and all these things, or whatever premium it takes, you will be able to make money.